Decoding the Market Symphony: The Impact of Economic Indicators on Investment Strategies. Introduction. In the labyrinth of financial markets, investors navigate a complex terrain shaped by an array of economic indicators. These indicators, ranging from employment figures to inflation rates, serve as beacons, illuminating the path for investment strategies. Understanding the profound influence of economic indicators on investment decisions requires delving into the intricate relationships that bind economic data to market dynamics. The pulse of the labor market. Among the myriad economic indicators, employment figures stand as a cornerstone in shaping investment strategies. The unemployment rate, job creation statistics, and labor force participation rates provide crucial insights into the health of an economy. Investors keenly observe these indicators to gauge consumer confidence, assess potential shifts in spending patterns, and anticipate the overall trajectory of economic growth. For instance, a declining unemployment rate and robust job creation may signal a thriving economy, instilling confidence in investors. In such a scenario, consumer spending tends to rise, benefiting sectors such as retail, leisure, and housing. Investors may strategically allocate their portfolios, favoring stocks in industries poised to capitalize on increased consumer demand. Inflation: the stealthy wealth eroder. Inflation, the insidious wealth eroder, exerts a profound impact on investment strategies. Central banks closely monitor inflation rates, and investors, in turn, adjust their strategies to preserve purchasing power. When inflation is on the rise, fixed-income investments such as bonds become less attractive, as the real value of future cash flows diminishes. Investors may pivot towards inflation-hedging assets like commodities, real estate, or dividend-paying stocks. Consider a scenario where inflation is surging due to increased demand or supply chain disruptions. Investors may reevaluate their portfolios, seeking assets that historically perform well during inflationary periods. This could involve a shift towards stocks in sectors with pricing power, such as technology or healthcare, and away from more interest rate-sensitive investments. Interest rates: the tug-of-war continues. The interplay between economic indicators and interest rates is a nuanced ballet that profoundly influences investment strategies. Central banks utilize interest rates as a tool to control inflation and stimulate economic activity. When interest rates rise, borrowing costs increase, potentially slowing down economic growth. Investors often adjust their strategies in response to interest rate movements, particularly in fixed income and equity markets. For example, in a rising interest rate environment, bond prices may decline, prompting investors to reassess their fixed income allocations. Simultaneously, sectors such as utilities or real estate, which are traditionally sensitive to interest rate changes, may experience headwinds. Conversely, in a low-interest rate environment, yield-seeking investors may flock to dividend-paying stocks, real estate investment trusts, REITs, or other income-generating assets. GDP: a barometer of economic health. Gross domestic product, GDP, the comprehensive measure of a nation's economic output, serves as a barometer of economic health and vitality. Investors scrutinize GDP growth rates to discern the pace and sustainability of economic expansion. A robust GDP growth figure may signal opportunities for investors, indicating a favorable environment for corporate profits and market appreciation. Consider a scenario where a country's GDP growth exceeds expectations, driven by factors such as increased consumer spending, business investments, and exports. In this context, Investors may adopt a growth-oriented investment strategy, favoring stocks in sectors poised to benefit from the buoyant economic conditions. Conversely, sluggish GDP growth may prompt a defensive investment stance, with a tilt towards more stable and resilient sectors. Consumer confidence and spending. The pulse of consumer sentiment reverberates throughout the economy, influencing investment strategies across various sectors. Economic indicators such as consumer confidence indexes and retail sales figures offer valuable insights into the mindset of the general public. When consumers are optimistic about the economy, they are more likely to increase spending, driving demand for goods and services. In a scenario of high consumer confidence, investors may position themselves strategically in sectors that stand to gain from increased consumer spending. Retail stocks, consumer discretionary companies, and industries catering to leisure and entertainment may be in favor. Conversely, a dip in consumer confidence might lead investors to adopt a more cautious approach, favoring defensive stocks and assets less reliant on discretionary spending. Global economic indicators. A mosaic of opportunities and risks. In an interconnected global economy, economic indicators from around the world weave a mosaic of opportunities and risks for investors. International trade data, currency exchange rates, and geopolitical events can significantly impact investment strategies. A strengthening currency in one region may attract foreign investment, while trade tensions or political instability may introduce uncertainties. For instance, if economic indicators point to robust growth in emerging markets, investors may diversify their portfolios to capture opportunities in these regions. Conversely, economic challenges or geopolitical tensions may prompt a flight to safety, with investors favoring assets perceived as more stable, such as those in developed markets. Conclusion. In the grand orchestration of investment strategies, economic indicators emerge as the instrumental notes that shape the symphony of financial markets. Investors, equipped with an understanding of these indicators, can conduct a nuanced analysis of market conditions and position their portfolios strategically. The dynamic interplay between employment figures, inflation rates, interest rates, GDP growth, consumer sentiment, and global economic indicators creates a landscape rich with opportunities and risks. It is through the discerning interpretation of these economic cues that investors can navigate the ever-evolving currents of the financial world. Crafting resilient strategies that stand the test of economic cycles and market fluctuations.